Hey everyone, I've got one growth stock that I'm going to bring you in this video that's down 66% off the high that I think makes an excellent investment for 2024 and beyond. I'm going to discuss all the factors that has me attracted to this growth stock and why I think it could do well for you. So let's get right into it. Let's see what the growth stock is and why I'm recommending it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, TripAdvisor is the growth stock that I'm recommending here. It's down 65.62% off the high, and I think it makes an excellent investment for 2024. Let's start to look at why I think that's the case. Starting with revenue. Now, of course, the company's revenue collapsed after the outbreak of COVID-19 when fewer people wanted to travel. Interestingly, in 2019, worldwide spending on hotels and resorts was more than $1.5 trillion. After the pandemic in 2020, that collapsed all the way down to $600 billion. Now, in 2023, there's estimates that suggest that it just barely passed 1.5 trillion again. Still, given the increases in inflation, people are still not traveling as much as they did in 2019. It's just that they're spending more on fewer trips. And so there's still room for consumers to unleash that pent up demand for travel that just to get back to where we were in 2019, that's not even accounting for any growth. So for that reason, I think TripAdvisor has more runway for growth here. 1.75 billion in revenue. Sure, that's higher than it was in 2019 of 1.6 billion, but that's primarily due to price increases and not so much due to increasing travel compared to the same level in 2019. And that's precisely what the analyst estimates are from Wall Street. According to Wall Street analysts, they expect revenue to increase by 9.3% in 2024 and another 8.9% in 2025, and that's expected to increase earnings by 30% in 2024 and another 22% in 2025. So robust revenue and earnings growth expected for TripAdvisor over the next 2 years, and that's unsurprising to me given the factor that I talked about earlier, all that pent up demand to unleash travel. Some of that came out in 2023. There's more to go. There's more to go. I suspect at least one more year of that pent up demand for travel before we reach the peak and then kind of stay at that level again in 2025. And then, given inflation and given the higher prices for everything from hotels to resorts to plane tickets to train tickets to everything that is related to traveling, that's going to increase the amount of total spending on travel worldwide. Now, despite this rebound, TripAdvisor's profitability is still not back to pre-pandemic levels. 100 million in trailing 12-month operating income still has more room to go to get back to where it was in 2019 of 200 million, and then even before that it was closer to 300 million. So it's recovering from the pandemic. You can see that V-shaped recovery, but there's still room to go, and investors getting in now can capitalize on that recovery for TripAdvisor going forward. The same thing with cash flow from operations. It's recovered and now it's dipping downward again. Before, in the summer season, it will jump back up when the summer season increases travel spending. Cash flow from operations 214 million, still solidly positive, but it's got room to move solidly higher over the next couple of years as revenue and earnings are expected to grow as it unleashes this pent-up demand. Now, the balance sheet is not in excellent condition, but it's okay. It's in stable condition now that the company is generating positive cash flow, positive profitability, 1.12 billion in cash and short-term investments, and 839 million in long-term debt. That means the company can use its cash and pay off all its long-term debt and still have roughly $300 million in cash left over. And given that it's in a position where it's generating cash, it's in a solid position. It's in a stable position. It's not getting worsened. It's actually improving. So the balance sheet is not a worrisome thing for TripAdvisor stock investors, and I suspect it will improve over the next 2 to 3 years as the company's rebounds to pre-pandemic levels of revenue and profitability. Finally, I wanted to talk about valuation, and the metric I chose to use is the price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. That being said, you can see TripAdvisor is trading at a forward price to earnings ratio of 11.6. That's the cheapest this stock has traded for according to this metric, going all the way back to early 2021. So you've rarely had an opportunity to buy this stock at this cheap a valuation. And given its excellent prospects going forward, let's remind you that it's expected to grow earnings by 30% and 22% over the next 2 years. This is an extremely attractive valuation. This is a cheap valuation when you're considering growth. What I like to do is I like to look at the forward PE ratio, and then I like to look at the growth rate in earnings expected over the next couple of years. And if the expected earnings growth rate is above the forward PE ratio for the next 2 years, I see that as a good sign. I see that as an indicator that makes the investment more attractive. So let's see what that is here. So 11.6 is the forward PE ratio. But look at the earnings growth rate expected. It's 30 and 22. So in each of those 2 years, it's expected to be higher than the forward PE ratio, and at 3 times and 2 times the rate of the forward PE ratio. That means the earnings are growing at 30% and then 20%, which means the price you pay today is going to look a lot cheaper 2 years from now because the earnings are going to grow that much more. So you're going to be getting so much more than what you paid for. So that's why I like to look at the earnings prospects over the next couple of years and compare it to the forward PE ratio to determine just how attractive the valuation is, even though it's already attractive just looking at a forward PE of 11.6. So for all those reasons, I recommend TripAdvisor as an excellent growth stock you can buy right now and hold for 2024 and beyond. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.